The plumbing is freezing. Somewhere deep in the bowels of the global financial system, in the overnight lending markets where banks trade trillions of dollars in the shadows, the pipes are clogging. The flow is slowing. The pressure is building. And when the plumbing freezes in the financial system, everything breaks. Not slowly, not gradually. Everything breaks at once. The stock market crashes. The bond market seizes. The credit markets lock up. And the only assets that survive, the only assets that actually gain value during the chaos, are the ones that exist outside the system entirely. Physical gold, physical silver, real assets that do not depend on a counterparty, a clearinghouse, or a bank that might not open tomorrow. What I am about to show you is the liquidity freeze that is forming right now, today, in the data that nobody in the mainstream financial media wants to discuss. This freeze will crash stocks. It will devastate portfolios. It will wipe out retirement accounts, and it will send silver to $500 per ounce as the world scrambles for the exit. Welcome to Vault Zero. The Ice Age is beginning. Let me show you the temperature readings. Before we examine the freeze, you need to understand what liquidity actually means in the context of the modern financial system. This is not a theoretical concept. This is the blood that keeps the body alive. Liquidity is the ability to convert assets into cash quickly and without significant loss of value. When you sell a stock, liquidity is what ensures there is a buyer on the other side of the trade. When a bank needs cash overnight to meet its reserve requirements, liquidity is what allows it to borrow from another bank. When a corporation needs to roll over its maturing debt, liquidity is what ensures there are investors willing to buy the new bonds. Without liquidity, the entire financial system stops. Transactions do not complete. Prices do not form. Markets do not function. A liquidity freeze is not a recession. A recession is a slowdown. A liquidity freeze is a cardiac arrest. The heart of the financial system stops beating, and everything downstream dies within minutes. We have seen this before. We saw it in 2008 when Lehman Brothers collapsed and the commercial paper market froze. We saw it in March 2020 when the COVID panic caused the Treasury market itself to seize up. And we are seeing the early warning signs of it right now, in the data that the Federal Reserve publishes quietly and the financial media ignores deliberately. Let me show you the data because the numbers are undeniable. The Federal Reserve operates several facilities designed to provide emergency liquidity to the banking system when normal market channels fail. The most important of these is the overnight reverse repurchase agreement facility, the reverse repo, and its counterpart, the standing repo facility. In a healthy financial system, these facilities see minimal usage. Banks borrow from each other. The market clears naturally. The Fed's emergency windows gather dust. But what we are seeing right now is the opposite of a healthy system. The reverse repo facility has been absorbing over $2 trillion in cash from money market funds for months. This tells you that there is so much excess cash in the system that it has nowhere productive to go. But simultaneously, and this is the paradox that should terrify you, the repo facility usage is spiking. Banks are tapping the Fed for emergency overnight cash, at the same time that money market funds are drowning in cash they cannot deploy. How can both things be true? How can there be too much cash and not enough cash at the same time? The answer is that liquidity is not evenly distributed. It is pooling in some places and draining from others. The money market funds are flush, the banks are starving, and the mechanism that is supposed to transfer cash from the flush to the starving, the interbank lending market, is breaking down. The interbank lending market is where banks lend to each other overnight to balance their books. If Bank A has excess reserves and Bank B is short, Bank A lends to Bank B at a rate called the federal funds rate. This market is supposed to be frictionless. It is supposed to be automatic. Banks know each other. They trust each other. The loans are overnight, so the risk is minimal. But trust is evaporating. Banks are looking at each other's balance sheets and seeing hidden losses. They are seeing unrealized losses on Treasury bond holdings from the rate hikes. They are seeing exposure to commercial real estate loans that are quietly defaulting. They are seeing derivatives positions that are underwater. And they are deciding that the overnight lending rate is not high enough to compensate for the risk that the borrowing bank might not be there tomorrow. So they are not lending. They are hoarding their cash. They are letting the other banks starve. And the starving banks are forced to go to the Federal Reserve's emergency window, which is the financial equivalent of admitting that no other bank will do business with you. The stigma of using the Fed's facilities is supposed to be so severe that banks avoid it at all costs. But the usage is spiking. That tells you the stigma is being overcome by desperation. The banks are so desperate for cash that they are willing to admit their weakness publicly just to survive another night. Now let me connect this to the stock market because the liquidity freeze in the banking system is the detonator for the equity collapse that is coming. The stock market does not exist in isolation. It is not a casino floating in space where prices move based on earnings reports and analyst recommendations. The stock market is a credit-dependent machine that requires constant liquidity to function. When corporations buy back their own shares, they borrow the money to do it. When hedge funds lever up to buy equities, they borrow on margin. When private equity firms take companies private, they finance the deals with debt. The entire upward momentum of the stock market over the past 15 years has been fueled by cheap, abundant credit. Remove the credit, and the momentum reverses. The buyers become sellers. The leverage unwinds. The prices collapse. What we are seeing in the repo market and the interbank market is the early stage of credit withdrawal. The banks that provide the credit are running out of liquidity. The Fed is backstopping them temporarily, but the Fed's backstop is not free money. It is a loan that must be repaid. The banks are borrowing from the Fed to survive, not to lend. They are hoarding, not extending. And when banks hoard, the credit that fuels stock buybacks, margin loans, and leveraged acquisitions dries up. The stock market is trading at all-time highs while the banking system is quietly freezing. This is the most dangerous divergence in modern financial history. The mathematics of the stock market crash are straightforward once you understand the leverage. American corporations have bought back over $5 trillion in their own shares over the past decade. They financed these buybacks primarily through debt issuance, taking advantage of the low interest rates that prevailed until 2022. But interest rates are no longer low. The debt that was issued at 2% now needs to be refinanced at 6% or 7%. The interest expense triples. The cash that was available for buybacks is now consumed by debt service. And without the constant bid from corporate buybacks, who is going to buy the stock? The retail investors are already fully invested. Their 401ks maxed out. The pension funds are overallocated to equities and looking to rebalance. The foreign buyers are fleeing dollar assets as de-dollarization accelerates. The only consistent buyer for the past decade has been the corporations themselves, and they are about to become sellers. Not because they want to sell, but because they need cash to service their debt. When a corporation faces a liquidity crisis, it sells its most liquid asset. Stocks are liquid. Real estate is not. Equipment is not. The stock portfolio goes first, and when corporations start selling stocks to raise cash to service debt, the prices collapse, which impairs the value of other corporations' portfolios, which forces more selling. This is the doom loop that the liquidity freeze will trigger. Let me give you the specific numbers on corporate debt because this is where the crash becomes inevitable. According to the Federal Reserve's own data, non-financial corporate debt in the United States now exceeds $13 trillion. $13 trillion in debt that American corporations owe to banks, bondholders, and other creditors. Of this amount, approximately $2.5 trillion matures within the next 24 months. These bonds and loans were issued when interest rates were near zero. They must be refinanced at current rates, which are 400 to 500 basis points higher. The annual interest expense on $2.5 trillion of debt increases by $100 billion to $125 billion when refinanced at current rates. $100 billion that corporations must find to pay interest instead of buying back stock, investing in growth, or paying dividends. Where does this money come from? It comes from cutting costs, which means layoffs. It comes from selling assets, which means stock sales. It comes from reducing investment, which means slower growth. And in many cases, it does not come at all, because the corporation cannot afford the new interest expense and defaults. The default rate on corporate bonds is already rising. Moody's is projecting a doubling of the default rate over the next 12 months. Each default creates losses for the banks that hold the bonds, which impairs their capital, which reduces their ability to lend, which tightens liquidity further. The freeze feeds on itself. Now we arrive at the critical question: if stocks are going to crash, where does the money go? In a normal market correction, money flows from equities to bonds. Investors seek the safety of Treasury securities, accepting lower returns in exchange for preservation of capital. But this is not a normal correction. This is a liquidity freeze. And in a liquidity freeze, bonds are not safe. We already saw this in March 2020 when the Treasury market itself seized up and the Fed had to intervene with trillions of dollars in emergency purchases to prevent a complete collapse. We saw it again in October 2023 when Treasury yields spiked and the term premium exploded, signaling that even the so-called risk-free asset was being repriced for risk. The Treasury market is the largest and supposedly most liquid market in the world, with $26 trillion in outstanding debt. But even this market is showing signs of stress. The bid-ask spreads are widening, the depth of the order book is thinning. The primary dealers who are supposed to make markets in treasuries are reducing their inventories because they cannot afford the capital charges. When the stock market crashes and investors flee to treasuries, they may find that the treasury market cannot absorb the flow. They may find that prices are gapping, that trades are not executing, that the safe haven is not so safe after all. This is when the panic becomes total. When both stocks and bonds are falling, when there is no shelter in the traditional asset classes, where does the money go? The answer is the same answer that has been true for 5,000 years of human civilization. The money goes to gold and silver. It goes to the monetary metals that have no counterparty risk, no default risk, no duration risk. When the paper burns, metal survives. When the banks close, metal remains. When the currency collapses, metal holds its value. This is not ideology. This is not gold buggery. This is the historical record. Every major financial crisis in modern history has been accompanied by a surge in precious metals prices. The 1970s stagflation sent gold from $35 to $850 and silver from $150 to $50. The 2008 financial crisis sent gold from $700 to $900 and silver from $9 to $50. The 2020 pandemic panic sent gold from $1,500 to $2,100 and silver from $12 to $30. In each case, the metals rose not because of industrial demand or jewelry consumption, but because they are the ultimate safe haven when confidence in the financial system collapses. And the confidence collapse we are facing now is larger than any previous crisis. Let me explain why silver specifically will reach $500 in this scenario, because that number is not hyperbole. It is mathematics. Start with the monetary dimension. The global money supply has expanded by approximately $40 trillion since 2020. Central banks around the world printed money to fund pandemic stimulus, to backstop failing banks, to finance government deficits that exploded during lockdowns. This money did not disappear. It is still circulating. It is sitting in money market funds, in bank deposits, in corporate cash accounts, waiting to be deployed. When the liquidity freeze triggers the flight from stocks and bonds, this money will seek physical assets. But the physical precious metals market is tiny compared to the ocean of money seeking shelter. The entire above-ground stock of silver, every ounce ever mined in human history that has not been consumed by industry, is approximately 2 billion ounces. At current prices of roughly $80 per ounce, the total value of all investable silver is $160 billion. Compare this to the $40 trillion in money supply expansion. If just 1% of the new money attempts to move into silver, that is $400 billion trying to squeeze into a $160 billion market. The price must rise to accommodate the flow. It must more than triple just to absorb 1% of the excess money supply. And 1% is a conservative assumption when the alternative is holding paper claims on a freezing financial system. Now add the industrial dimension. Silver is not just a monetary metal, it is the most electrically conductive, thermally conductive, and reflective element known to science. It is irreplaceable in solar panels, where silver paste forms the conductive pathways that capture and transmit electricity. It is essential in electric vehicles, where silver is used in batteries, electronics, and motors. It is critical in 5G infrastructure, medical devices, water purification, and military applications. Global industrial demand for silver exceeds 600 million ounces per year and is growing at 5% to 7% annually as the green energy transition accelerates. But global mine supply is only 800 million ounces per year and is declining as the major deposits are depleted and new discoveries fail to replace them. The market is already in a structural deficit of approximately 200 million ounces per year. This deficit is being filled by drawing down above-ground stockpiles, the same stockpiles that investors will be competing for when the liquidity freeze hits. You cannot solar panel your way out of a silver shortage. You cannot EV your way out of a silver shortage. The industrial consumers need the metal to manufacture their products. They will pay whatever price is necessary to secure supply. And when industrial buyers and investment buyers are competing for the same shrinking stockpile, the price does not rise linearly. It rises exponentially. Now add the short squeeze dimension. We have discussed in previous videos the concentrated short position held by the major bullion banks. These institutions have sold hundreds of millions of ounces of silver through futures contracts and derivatives, silver they do not possess and cannot deliver, As the price rises, their losses mount. As their losses mount, they face margin calls. As they face margin calls, they must either post additional collateral or close their positions by buying back the contracts. But buying back the contracts means buying silver in a market that is already in deficit, with stockpiles that are already depleted, while competing with industrial users and investors who are also desperate to acquire metal. The short covering adds another layer of demand on top of the already insatiable demand. It is forced buying that is price insensitive. The shorts must cover regardless of the price. If the price is $100, they cover. If the price is $200, they cover. If the price is $500, they cover. They have no choice. The alternative is bankruptcy. And when the short covering begins in earnest, the price will not rise in an orderly fashion. It will gap. It will jump $50 in a day. It will be halted. It will reopen higher. This is what a short squeeze looks like in a market where the shorts cannot deliver the underlying asset. Now add the currency dimension. The liquidity freeze we are describing is not just an American phenomenon. It is a global phenomenon. The European banking system is more fragile than the American system, with Deutsche Bank, Credit Suisse's successor, and the Italian banks all showing signs of stress. The Japanese banking system is trapped between a central bank that cannot raise rates without bankrupting the government and inflation that is eroding the value of the yen. The Chinese banking system is dealing with a property crisis that has left trillions in bad loans on the books of state-owned banks. Every major currency is issued by a banking system that is freezing, a government that is insolvent, or both. When confidence in all fiat currencies collapses simultaneously, the only refuge is assets that are not denominated in any currency. Gold and silver are priced in dollars for convenience, but they are not dollars. They are elements. They are atomic, they are real, and they are finite. The repricing of precious metals during a global currency crisis is not a percentage gain. It is a regime change. It is a new monetary order where the metals reclaim their historical role as the foundation of value. Silver at $500 is not the ceiling in this scenario. It is the floor. It is the starting point for a new equilibrium where silver is valued not against a dying dollar, but against the real goods and services it can command. Let me address the skeptics who say that $500 silver is impossible, that the system will never allow it, that the authorities will intervene to prevent it. I have heard this argument for 20 years. I heard it when silver was $5 and they said it would never reach $10. I heard it when silver was $15 and they said it would never reach $30. I heard it when silver was $30 and they said it would never reach $50. The interveners have intervened. They have manipulated. They have smashed the price during overnight sessions. They have changed the margin requirements. They have leaned on the exchanges. They have done everything in their power to prevent the price from reaching its natural equilibrium. And they have failed. The price is $80 and rising. The Shanghai price is over $100. The suppression machine is breaking because it is running out of ammunition. You cannot suppress a physical market with paper contracts forever. Eventually, someone demands delivery. Eventually, the vaults are emptied. Eventually, the promises are called due. We are in the eventually now. The COMEX registered inventory is at historic lows. The delivery demands are at historic highs. The premiums in the physical market are at levels that indicate a complete disconnect from paper prices. The suppression is ending because it is mathematically impossible to continue. And when suppression ends, the price does not rise to fair value gradually. It rises violently as decades of artificial constraint are released in a matter of months or weeks. The timeline for this scenario is not years away. It is months away, possibly weeks. The liquidity indicators are deteriorating rapidly. The bank earnings reports are showing rising loan loss provisions and shrinking net interest margins. The commercial real estate market is in freefall, with office building valuations down 40% and regional banks holding billions in loans secured by these collapsing assets. The interest rate on the 10-year Treasury is pressing toward 5%, a level that breaks the math for corporate borrowers, mortgage borrowers, and the federal government itself. The deficit is $2 trillion per year and rising. The interest expense on the national debt is approaching $1 trillion annually. The Treasury is issuing billions in new debt every week just to pay the interest on the old debt. This is a Ponzi scheme in its terminal phase. The only question is what event triggers the final collapse. It could be a bank failure. It could be a Treasury auction that fails. It could be a geopolitical shock. It could be a derivatives blow-up that cascades through the counterparty network. The trigger is unknowable. The outcome is inevitable. What should you do with this information? First, reduce your exposure to the financial system. This does not mean selling all your stocks tomorrow. It means understanding that the assets you hold within the system, the brokerage accounts, the retirement accounts, the bank deposits, they are claims on institutions that may not survive the freeze. Diversify outside the system. Own physical assets that you control directly, real estate that is paid off, precious metals in your possession, productive land, tangible goods that have value regardless of whether the banks open on Monday. Second, acquire physical silver specifically, not paper silver, not ETF shares, not futures contracts. Physical metal that you can hold in your hand or that is stored in an allocated vault that you control. The paper silver market is a derivative of the physical market, and derivatives can go to zero when the underlying market seizes. We saw this with the nickel market in 2022 when the LME simply canceled trades that went against the wrong people. We will see it again in silver when the COMEX cannot deliver and declares force majeure. The paper holders will get a check at a price determined by the exchange, a price that will be a fraction of the physical market value. The physical holders will have the metal, which they can sell at the real price or hold for further appreciation. Third, understand that the transition will be chaotic. There will be days when the paper price of silver crashes because the banks are desperately dumping contracts to raise cash. There will be days when you cannot buy physical silver at any price because the dealers have no inventory. There will be days when the gap between paper and physical is $50 per ounce or more. Do not panic during the chaos. The chaos is the transfer mechanism. It is how the wealth moves from the paper holders to the physical holders. If you are holding physical, you are on the receiving end of the transfer. Just hold. Do not sell into the chaos. Do not try to trade the volatility. Just hold and let the system reprice around you. Fourth, prepare for the social and economic consequences of the crash. A liquidity freeze that collapses the stock market and sends silver to $500 is not a financial event in isolation. It is a societal event. Pension funds will be devastated. Retirement accounts will be halved. Unemployment will spike as corporations fail and credit dries up. There will be political turmoil as people demand answers and scapegoats. There may be capital controls as governments try to prevent money from fleeing the country. There may be asset seizures as desperate governments grasp for revenue. Having physical silver is not just about making money, it is about having a portable, liquid, universally recognized store of value that you can use to survive and rebuild in the aftermath. Silver has been money for 5,000 years because it works. It works when the banks close. It works when the currency fails. It works when the government cannot be trusted. It will work in whatever comes next. The liquidity freeze is happening, the plumbing is clogging, the pressure is building, the stocks are going to crash because the credit that inflated them is being withdrawn. The bonds are going to crash because the governments that issue them are insolvent. The dollar is going to crash because the Fed will print trillions to try to save the system and destroy the currency in the process. And silver is going to $500 because it is the escape hatch from all of it. The escape hatch is still open. The metal is still available, though the premiums are rising and the wait times are extending. But the escape hatch will not stay open forever. When the freeze becomes a crisis, when the stock market gaps down 10% in a day, when the bank holiday is declared, the escape hatch will slam shut. The metal will be unobtainable at any price. The people who prepared will have it. The people who waited will wish they had. I have shown you the temperature readings. The repo market is spiking. The interbank lending is freezing. The corporate debt is coming due. The treasury market is straining. The metals are breaking out. Every indicator is pointing to the same conclusion. The system is freezing. The crash is coming, and silver is the asset that benefits most when paper dies and real things are repriced. $500 per ounce is not a fantasy. It is the mathematical result of 40 trillion in excess money supply competing for 2 billion ounces of silver in a world where the financial system has lost credibility. It is the historical norm adjusted for the monetary expansion of the past 50 years. It is where silver would be trading today if it had not been suppressed for 4 decades by banks selling metal they did not have. I am Vault Zero. This is the breakdown. The liquidity freeze is happening. The stock crash is coming. And silver is going to $500 as the world discovers that the only safe haven is the one that exists outside the system entirely. The banks cannot freeze your silver. The Fed cannot print your silver. The government cannot devalue your silver. It is yours. It is real. And it is about to be repriced to reflect its true value in a world where paper promises are revealed to be worthless. Get your metal. Get it now. Get it while the escape hatch is still open. Because when the freeze becomes complete, when the system locks up, when the banks close and the markets halt, the only people who will be whole are the people who saw it coming and acted while there was still time. You have seen it. Now act. Like and subscribe for the next report. Share this with someone who is still asleep, and I will see you in the vault when the storm passes. The ice age is here. The temperature is dropping, and only metal survives the cold. Stay warm, stack silver, and welcome to the new reality.